Good evening. Sir, please come to paragraph 6, credit rating process. First 5 paragraphs we have done. Any query? No. This is a very easy chapter and I have made a comprehensive note on this. I have added few paragraphs also which was not there in the ICI material. Now what do you do as a credit rating company? So credit rating process means basically you have to analyze the instrument or the company depending upon what is your scope of work, and accordingly you give a credit rating. Okay, and then based on that credit rating the decision maker will take the appropriate decision. So the default risk assessment and quality credit rating assigned to an issue are primarily determined by 3 factors. So what the credit rating companies do when they are credit rating an instrument, they are checking one, the issuer's ability to pay, because accordingly the rating is given, and the strength of the security owner's claim on the issue. Can the security owner, that means the investor, claim the assets of the company and the economic significance of the industry and the marketplace of the issuer? What is the industry in which the entity is operating? Economic significance, whether that industry will generate enough return to give cash flow and therefore the amount can be repaid, and the marketplace of the issuer, where does the issuer stand in the industry? These are the broad factors. These are the broad factors which will help the credit rating company to determine the credit rating of a instrument. Okay, now here they have given a small flow chart how the credit rating is done. Pre-rating, what they do before they do the rating, and then rating, and then after rating also. So pre-rating involves rating mandate and agreement. Rating mandate means what instrument has to be rated, and then the issuing company and the credit rating company will enter into an agreement. Then non-assurance of particular rating. Credit rating does not guarantee anything. Credit rating company does not assure you that we will give you a certain rating. Explanation of the critical policy and process to the issuer. Just like when you do the audit, you have to explain your audit procedure to the client. Same way, the credit rating company will explain the critical policy and procedure to the client so that the client should be ready with those kind of information, and then they sign a confidentiality requirement, because credit rating company gets to know lot of information about the company which they will not reveal to any third party. It is, you can say, similar to audit, but audit has a different scope of work. But there also you are giving an opinion on the financial statement of the company. Here we are giving an opinion on the instrument, whether the company will be able to repay interest and principal on that instrument. So therefore the pre-rating procedure is similar to your audit procedure only. Entering into an agreement, signing a confidentiality agreement, explaining the procedure that you follow, and you do not guarantee any particular rating. You will give the rating according to your observation. And then rating. Now next step is, once you do your work, you do the rating. Consistent application of rating policies. Use of criteria, research and management meeting. This we will discuss in the next few paragraphs, because here they are giving you the headings of what the rating does. Use of criteria, research and management meeting. Based on your findings, you do a meeting with the management, okay, and then you tell the management this is our view, take their view also, and then the rating committees, every rating company will have a rating committee, and they will give the rating, and the rating is informed to the management. Management may accept the rating or management may appeal for revising the rating, which the rating agency may or may not revise. Like in your audit report, when you prepare the audit report, you first hand over a draft copy to the management. After going through your audit report, management will say, oh, why you have given this qualification? Kindly review your qualification. Then as an auditor, what we do? We either review our qualification or we say, no, this is our qualification. Now it is up to you. So same thing happens in rating agency. The moment they give a lower rating, the management will be after your life. They will pressurize you. They will give you incentive, officially or unofficially, and they will try to get the rating in their favor. Is it right? But again, it is on the independence of the credit rating company whether they accept your view or not. And then post rating means once the rating is done, accepted by the management, it is published, and then people can review the rating and accordingly take the investment decision. But now SEBI has asked the rating company, even if you have rated the instrument, it is not that your job is over. You have to keep on reviewing your rating. Suppose you have issued a 5-year bond. It's not that the circumstances, situation will remain the same. So that is surveillance. Rating companies, if required, they may withdraw the ratings also at a later stage also. Maybe a bond was issued with AA rating, but later on the condition of the company has gone bad and they are not able to pay the interest or principal. They can even revise their rating or withdraw their ratings also. So this is post rating. So next 1 or 2 pages now will give you an insight into how the credit rating is done. How long the company has to do surveillance depending upon the period of the instrument. If it is a 5-year bond, then they have to continuously, periodically they have to do the review. Okay. But that is one of the drawbacks of credit rating, because later on if something goes wrong, then investors will be at a loss, but at least they can give them some warning in advance. Now next is credit rating process. So request from issuer and analysis. A company wants to issue a bond or debenture. So what they will do, they will hire a credit rating agency. And then the role of credit rating agency starts. A company approaches a rating agency for rating a specified security. A team of analysts. Now the rating company will send his team of analysts. Like in your company, when a client wants to get audited, you, the gang of articles, they attack his company in the early morning. Okay. So here the team of analysts interact with the company's management. But normally in case of credit rating, all these people are well qualified analysts. They would be minimum something like a CA, an MBA. Okay. Then they directly interact with the management of the company and they will collect whatever information they want, like balance sheet, P&L account. So we will see the areas which they look into. They will look into the historical performance. They will take last 4 or 5 years of balance sheet, P&L account, cash flow statement, and they will see what is the earning growth rate, okay, etc., etc. What you learn in that ratio analysis chapter, debt equity, return on investment, EPS, cash flow generated per share, all this analysis is done. So your chapter in intermediate syllabus called ratio analysis is very important in understanding the historical performance. Absolute number may not make much sense. So they will check ROI, return on investment, EPS, etc. I am not writing all. Then they will see your competitive position in the industry. Okay, market share of the company. You can write your own answer in the exam. Once you understand the logic, what will you do? Competitive position. Are you a monopoly, oligopoly, monopolistic competition? Then what is your business risk profile? Now, business risk profile, some example I will give you because this is a separate heading after 1 or 2 pages. Business risk means risk of making losses. Risk of making losses. That means your cost may be more than your revenue is business risk. So business risk means the company might not be able to make the profit. That is business risk. Why don't most people do business? Because profit may be negative. And why? Due to competition. Like Bharti Airtel Limited wants to issue debentures and bond. This factor will be very important in determining their rating. Who knows, next 5 years they may not remain profitable. Reliance Jio will make another round of free offering. Vodafone will make another round of free offering. Not only that, now the government BSNL, they are also planning to offer a matching scheme also. More data per day. So then this company will have a trouble. Then technology may change. Substitute product may emerge. Government policy may change. Government policy may change. You are manufacturing petrol car, diesel car, but then government will say now we will promote electric cars. Okay, and those which will manufacture petrol and diesel car will have to pay more excise duty or more GST. Those which will manufacture other car will pay less taxes. So this will affect your business profile. Okay. Some more example we'll see in one subsequent paragraph. Business risk we'll discuss in detail. Then other areas covered are business strategies. What are the strategies the management adopts? This also will discuss in a separate heading. And financial policies and short-term or long-term outlook of the performance. That means the credit rating company will analyze these factors in detail and prepare a report on each of these topics. Based on that, the rating committee will sit down and decide what rating should be given. What are the other factors that they consider in the next bullet point? The other factors they cover are industry in which the issuer operates. Because nowadays this is very important. If you are operating in, say for example, telecom industry, then what is that industry? Does it generate profit? If you are operating in airline industry, then you will have to analyze whether in airline industry what is the profit, how much profit margin is there, how many players are there, its competitors and markets are also taken into consideration. Actually, these are all part of business risk which we have covered. Then once you do the basic work, groundwork, the analysts do the groundwork, they submit their observation, okay, or the report to the rating committee. Within the credit rating company, there is a rating committee. Like your articles, you submit your work report to your senior manager or manager, sometimes partner in a small firm directly. So then the rating committee, in this example, credit rating company, they will prepare a rating report. On the basis of the information obtained, an assessment made, the team of analysts present a report to the rating committee. The issuer is not allowed to, of course, participate in this process. Why will the issuer be allowed to participate? Otherwise, he will influence the process. When you are writing the audit report, is the management sitting with you? No. Same here also. When you are writing a rating report, why will you involve the management? Otherwise, your independence is lost. As it is an internal evaluation of the rating agency. The nature of the credit evaluation depends on the type of information provided by the issuer. So based on all the information that you gather about your past performance, competition, government policy, technology, substitute, the rating agency will give you a information. So management should be careful while giving the information. Is it right? Because that is the source of knowledge for the credit rating company. Now what the rating agency do, rating committee will do, they will make a communication to the management first. In our opinion, this is the rating of this instrument. But at the same time, the management has a right to appeal. They'll say, no, we do not agree with your rating. So what we will do? So there are 5 steps involved here. See the step number 1. Rating decision is communicated to the issuer, and then supporting the rating is shared with the issuer. It means you will communicate your rating. You will also give the reason, the evidence, okay, the documents, the source on which you have relied while giving this rating. So this you have done. Okay, so take my rating. This is to the management right now. Management will go through this. If the issuer agrees or disagrees, an opportunity of being heard is given to him. Suppose the company says, no, we do not agree with this AA, we want AAA. Come, meet, we'll discuss. Then issuer appealing against a rating decision are asked to submit relevant material information. Company says, no, we don't agree with your. Okay, then you submit what information you want to submit so that we may rethink about our rating. Management will give them more information. The rating committee reviews the decision, although such a review may not alter the rating. May or may not. After going through the additional information, rating agency may or may not revise the rating already given. And once this step is over, now there is no chance to the management. The issuer may reject the rating and the rating score need not be disclosed to the public. Then again they will have to do the entire process again. Okay. But mostly it will not happen. Otherwise they can't issue the instrument. Yes or no? Without credit rating, can you issue the debt instrument in India? You cannot. But in case if you are not happy with the rating, you can just close the process altogether. Now suppose the management has accepted the rating finally. Next step is pronouncement of the rating. Just remember, they can ask you a question, what are the sequence in which the rating agencies do their analysis. So in this 6 or 7 sequence you have to remember. What was the first one? First one is that request from the issuer and analysis, then rating committee, and then communication to management. Management will appeal, after that pronouncement of the rating. So this sequence you remember, and in that sequence the rating has to be done. If there is an MCQ on this point, pronouncement of the rating, if the rating decision is accepted by the issuer, the rating agency makes a public announcement of it. So now they are going to announce it to the public. So they will come out with a prospectus in which they will write, this instrument is credit rated by this company, this is the rating given, this is the meaning of this rating. Okay. Then next task is monitoring of the assigned rating. Task is not over. Out of 3 steps, 2 we have done. Pre-rating, rating. Now this is a part of post-rating. Point number EF is a part of post-rating activity. Monitoring of the assigned rating. The rating agency monitor the ongoing performance of the issuer and the economic environment in which it operates. All ratings are placed under constant watch. SEBI has made it mandatory now in India that your job is not over. You have to continuously monitor your rating because situations may change, circumstances may change, the information on which you relied upon at the time of rating may change. So there will be a constant watch on the instrument. In case where no change in rating is required, the rating agency carry out an annual review with the issuer for updating of the information provided. Now next is a concept of rating watch. Which watch? Rating watch. Again, point number E will be further explained here. That means you have to keep a watch on the rating assigned, and if required, you may have to change it also. Based on the constant scrutiny carried out by the agency, it may place a rated instrument on rating watch. Rating watch here means constantly they will monitor that instrument. Like India as a country is under rating watch of global rating agencies, Standard and Poor, Moody, and every 6 months or 1 year they either upgrade India's rating or further degrade it also. Same thing can be done by the Indian rating agency for the instrument also. The rating may change now for the better or for the worse, both. So the question in the exam will be, credit rating can be revised only for the worst situation, not for the better. The answer is no. The credit rating is suppose AA. It can be upgraded to AAA. It can be downgraded to A. This is upgrade. Means situation is better now. This is downgrade. Situation is worse now. We will discuss the meaning of these rating agency symbols in the next paragraph. H, don't worry. Rating which is followed by a full scale review for confirming or changing the original rating. Rating watch is followed by a full scale review for confirming or changing the original rating. So if the rating company thinks that now we have to revise our rating, a full scale review, that means again they will go into the same detailed procedure which they have followed earlier for making or revising the estimate rating. If a corporate which has issued a 5-year, for example, 8% debenture merges with another corporate or acquires another corporate, it may lead to some spelling mistake in the study material we need to change. Institute module also says the same. If a company has issued a 5-year, for example, 8% debenture, but before the terms of the debenture is over, it merges with another corporate or it acquires another corporate, it means again the risk has changed. So what they will do, the credit rating will re-rate the specified securities. These two things you have to revise. Credit rating will re-rating of specified securities. Securities what you have to add, because such corporate events can affect the risk. Merging with other company, acquiring other company means again your entire balance sheet and profit and loss account undergoes a change. Now next is very important, rating coverage. Mostly in India debt instruments are rated, but rating is not limited only to specific instrument. Ratings also include, which we discussed on the previous lecture also, public utilities, financial institutions, transport, infrastructure and energy project, special purpose vehicle, domestic subsidiary of foreign entities. These are specific rating. That means you want to know some information about a certain company, then the rating company will do that specific task for you. In the previous lecture we saw insurance companies are also rated, whether they will be able to pay the claim or not. Is it right? Countries are rated. Useful for investor who want to invest in a country, that is credit rating of a country is also performed. Credit rating of entire company can also be performed. But these are all situation based, where a particular company wants a certain information, then they can go to credit rating. But mandatory is that debenture bonds issued in India or commercial paper issued in India, where the SEBI makes it mandatory for going for credit rating. Others depend on the situation. Now, rating coverage, next paragraph, structured ratings. Now you will ask, what is structured rating? Write down what is structured rating. Those who want to write. Structured rating, you can write on the right side, there is some space. It is based on the assessment of, it is based on the assessment of, it is based on the assessment of risk associated with, it is based on the assessment of risk associated with individual component, of the structured instrument, First you write, then I'll explain. These components include legal risk, credit quality of underlying asset, etc. And then write below one more thing. What is the meaning of structured instrument? It means structured finance is a complex financial instrument. Structured finance is a complex financial instrument offered to borrowers with unique and sophistication needs. Offered to borrowers with unique and sophisticated needs. Is it right? Now let us read now, because they have used some complicated terms in the statement. Structured ratings are given to MNCs based on guarantees or letter of comfort and standby letters of credit issued by the banks. So this is also covered by rating agencies. That means suppose there is a structured instrument. Structured instrument is a complex instrument. Like for example, if you have studied about securitization, have you heard? In your syllabus we have covered also. In securitization, what happens? A housing loan company gives loan to a customer. Then first it comes in the books of housing finance company. Then it is sold to SPV. Then the SPV will issue different types of debt instrument based on that collateral. So that is a structured instrument, because it is not a simple instrument. The payment of that instrument will be made out of the collection from the underlying receivable. If they don't pay, there can be a default in the payment of that instrument. So what they do, these rating companies also rate the structured instruments, where they will rate individual component of that instrument. Individual component, example, legal risk, credit risk, etc. Okay. Mostly these big entities like MNCs, they issue such structured instrument, complex instrument. The rating agencies have also launched corporate governance rating. What is a corporate governance rating? That means they will see whether a company is observing the code of corporate governance or not. Have you heard this word, corporate governance? These are some basic ethical principles which the company should observe, because a company is run by management but owned by shareholders. There are a lot of stakeholders in the company. So the company's management should behave in such a manner that the interest of the stakeholders are taken care of and there is no conflict of interest, they don't make personal gains. Nowadays, the rating agencies can even do the corporate governance rating also, which is very important in modern business world. We will say that corporate governance of this company is not good. The moment they say that, many investor will run away from that company. Okay, so corporate governance rating can also be done now with emphasis on quality of disclosure standards and the extent to which regulatory obligations have been complied with. Have you ever read the annual report of a company? Full annual report of a listed company. You should go through the first few pages before the audit report starts. There the management gives lot of disclosures about what they have achieved in the past and what is their vision for the future. And they give lot of disclosures like who are the directors, qualification, how many meetings they have attended, okay, etc. etc. That disclosure will give a lot of information to the shareholder and other stakeholders. And plus, corporate governance also includes whether the company is complying with all the regulations or not. So they have a separate checklist for corporate governance. And that is also rated nowadays. So this is the scope of rating agencies. Not just debt instrument, but so many other areas are also covered by the rating agencies. Now something very important and interesting. After the rating is over, there is a convention of assigning a credit rating score or credit rating symbol. You can either call it score or you can call it credit rating symbol. Okay. So what I have done, I have divided this credit rating symbols into three categories. In your ICI matter, only one category is mentioned, long-term instrument. But I have also mentioned medium-term instrument and short-term instrument. Now, if any question is asked on rating agency symbols, you have to come to this page in the exam and you have to check. No need to remember. But I will explain briefly. For long-term debt instrument, we have taken two instruments here, debentures and fixed deposit. Okay. And then we have taken four agencies which do rating for long-term instrument. Example, CRISIL, one of the oldest agencies in India and one of the biggest agencies in the world, CRISIL. ICRA, CARE. Will discuss in detail all these four agencies in the later part of this chapter. Fitch is an international rating company which now has a subsidiary in India. Fitch is an international rating agency. It operates through an Indian subsidiary. In the world, there are three main rating agencies: S&P, Standard & Poor, Moody's and Fitch. And this Fitch has a subsidiary in India. So how do they do the rating? Suppose they believe that the instrument has highest safety. That means the risk of default is negligible or almost non-existent. Almost non-existent risk. Company is going to pay interest on time, repayment of principal on time. So CRISIL will write AAA. So if you see AAA, what does it indicate? One, it is a long-term instrument. It is rated by CRISIL, and in the opinion of CRISIL, it is a highest safety instrument. Okay. So the question will be, what do you mean by AAA rating? So it is a sign of highest safety in a long-term instrument, and the instrument is rated by CRISIL. What about ICRA? What ICRA does, it has a similar rating, but they will write L before it. L AAA means long term, L for long term and AAA. So the moment you see L AAA, it is rated by which agency? ICRA. It has rated a long term debt instrument. What CRISIL does, CRISIL write CARE AAA. CARE AAA in bracket L. So CARE indicates rated by care company. This is another agency. Triple A means highest safety and L is for long-term instrument. And this Fitch company, Triple A in bracket they write India. Means it is an Indian company's debt instrument because they have subsidiaries in different countries. That also we'll discuss in the later part, how many subsidiaries they have, in how many countries they operate. Then high safety. So now as we move from top to bottom, the risk will increase. So triple A becomes double A means high safety. So this is also a very good instrument, but of course it has a little higher risk compared to triple A. Then if I move to A, it means adequate safety. Triple B moderate safety. Double B inadequate safety. And in other three agencies also it is moving in the same manner. Have you noted? But each company has a different lettering. ICRA uses the word L every time. CARE uses CARE and in bracket L. And this Fitch company write it. So the moment you see any of these letters, you can identify which rating agency have issued it, what is the meaning of this, and it is a long-term instrument. After double B, high risk, B, substantial risk, C, and default, D. Easy to understand. Starts with highest safety and it moves towards the last, that is default. So as an investor, what happens now? When you see these ratings, you know what is the risk involved, what is the safety involved. Suppose you are investing in a triple B rated bond, so you know that it has a risk involved. It has a moderate safety means it has higher risk involved. If you are investing in a triple A rated bond, you are mentally sure at that point of time that it is the highest safety instrument at that point of time. If you are investing in a C or D rated bond, it means the risk of default is substantially high. Knowingly this, you can invest. Of course, the advantage of investing in a B, C or D rated bond is that you will get a high rate of interest. If a triple A rated bond gives you 8% interest, then B will give you 14, C may give you 15 or D may give you 18 also, because then the borrower has no choice but to offer you high rate of interest. And that is why the management will continuously pressurize you to give the highest rating, because better the rating, lower the interest rate you have to pay. Chances are that your instrument will get insured also by an insurance company, and therefore the instrument becomes even a better instrument if it is insured by an insurance company. Okay, chances are that in future also you'll be able to raise more funds, so it improves the goodwill and image of the company indirectly. What about fixed deposit? In fixed deposit we have three categories: highest safety, high safety, adequate safety. And the letters they use is F triple A, F double A, FA. ICRS is M triple A, M double A, MA. And this credit CARE says CARE triple A, CARE double A, CARE A. Fitch is T triple A, T double A, TA. Some letters they will change so that you can understand which agency has rated this instrument. Institute's material only gives you this much rating. Two more paragraphs I have added from my side also. Medium term instrument rating. Now I'll read from your book. Medium term instrument rating. Here I have only written three agencies in India because this much data I could generate. CRISIL, ICRA and CARE. Highest safety, CRISIL will write FAM, ICRA write M triple A, and CARE writes CARE triple A. Then high safety, medium term instrument is usually around say 1 to 5 year. Long term instruments are more than 5 year, 5 and above. and this is 1 to 5, right in bracket 1 to 5 here. Then high safety I have told you FAA, MAA, care AA. Adequate safety FA, MA, then care A. Inadequate safety FB, or not your FB, okay, MB, care BB. High risk is FC, ICR is MC, care B. Default FD, MD, care D. The plus and minus sign may be applied. Now I'll explain what is plus and minus sign. Now you want to give rating between AA and AAA, for example. For example, it is applicable to all of them. You think that it is more than AA but less than AAA. So what rating you can give? AA plus. Means it is somewhere between these two. Or you can give AAA minus, which means again somewhere between this. Like in a movie rating, 3.5 star they give to a movie out of 5. So what does it indicate? Between 3 and 4. It is better than good, but not very good. Okay. In movie rating, 3 is good, 4 is very good, but is more than good but less than very good. So similarly here also, some companies also get AAA plus rating. AAA plus means it is even better than a AAA rated instrument also. Okay. So plus and minus sign may be applied to reflect the comparative standing within the same grade or category. Not see short-term instrument rating. Again, I could generate data for these 3 companies only. CRISIL, ICRA, CARE. Institute should have given this also. They have not. No problem. Highest safety P1. ICRA A1 plus or just A1. A1 plus they can write, means good. Even A1 is enough, and CARE will write PR1. High safety P2. A2 plus or A2, PR2. Adequate safety P3. A3 plus or A3, PR3. Inadequate safety P4, PR4. Here they have not written, but it may be. There is no inadequate safety criteria in ICRA because A4 is here. High risk. Now there is no criteria written by CRISIL here, but this has A4. Again, no rating for high risk, and directly default after inadequate safety P5, A5, and this PR5. You make it PR5. If you see the rating 1, 2, 3, 4, 5, typing error. This I have added in your notes in case if they ask for short-term instrument. My purpose is that now you got a very good overview how the rating is done. And of course, it will require a lot of understanding of the financial statements. CRISIL may apply plus sign from P1 to P3 to reflect a comparative higher standing within the category. That means they can also give you P1 plus rating, P2 plus rating, or P3 plus rating. Doesn't matter, just like this company has done. Even CRISIL can add plus sign indicating a little better situation. P1 plus is better than P1 situation. If they ask you what does plus minus sign in credit rating means, so it is between the 2 ratings. Okay, it is between the 2 ratings. So sometimes the rater may think it is better than AA but not as good as AAA. So AA plus. It's like a rating of 3.5 in a movie. Okay, 4.5. Now there will be some repetition. Credit rating methodologies. Although the heading is credit rating methodologies, but here we are going to discuss more about the various type of risk which they look into while doing the rating, because ultimately we want to see whether the company will be able to pay the interest and principal or not. And this is important because one chapter in your syllabus is risk management. Again, the same 2 pages will get repeated there also. And in SFM also there is one chapter, risk management, theory part. Again, the same will be repeated there also. So don't worry. The general methodology adopted by credit rating companies is to analyze various aspects of a business, because ultimately they want to ensure that company should be able to repay its interest and principal. While discussing, our basically discussion is the ability of the issuer company to pay interest and principal, and for that you have to understand the whole aspect of a business. Okay, the first aspect we'll see today is called business risk. What is business risk in a simple word? Risk of incurring a loss. What is the meaning of loss? Cost is more than revenue. That means your revenue is not sufficient to recover the cost incurred. That is the business risk. Somebody is not going to hang you. It means you will not be able to recover your cost, so you have to suffer a loss. So business risk occurs when there is a possibility of a company earning lower profit than anticipating or incurring a loss. Now, categories of business risk. We will divide our discussion into 4 parts. Same thing is there in the risk management chapter also in SFM. Okay. So categories of business risk will be strategic risk. We'll discuss compliance risk, operational risk, and reputational risk. Then your question will be, what is a strategic risk? In the exam they will say strategic risk means dash dash dash, and you have to choose the right answer from this. Okay. Or business risk means dash dash dash, then you have to choose the right option. So each line I have written in detail in a separate bullet point. Whatever they can ask you, now you can write down. So what is strategic risk? It means your strategy may go wrong. Strategy may go wrong. 2-3 examples we'll discuss. Example of company like Kodak we'll discuss. Nokia we will discuss. Okay. Later. Every company, every management will make a plan. Strategy means plan for future action. Okay. But every plan, even though well thought out, comprehensive, too much of detail, can change. Yes or no? But it is a fact of life that if things changes, even the best laid plans can become outdated if it cannot keep pace with the latest trend. Change is the only constant. Is it right? Kodak. Kodak moment. Have you heard Kodak moment? It was, you can say, like a monopoly in the camera business. Okay. And everywhere you'll find Kodak. But do you find Kodak everywhere now? It has been liquidated. It has gone into bankruptcy. Why? Because now this digital photography has come, and they had this shutter wala thing. You click it, then there is a reel, a black reel, on which the image gets captured, and then it has to be, whatever you call it, processed, and then you get a photo. But nowadays digital cameras have come, where even a small child of 5-year-old can click the picture easily. Any number of pictures you can click, and it has made your life very easy. But Kodak was little delayed in adopting that technology. By that time, other Japanese and Korean companies and American companies had entered the market. They were the first one to bring it to the industry of digital editing. We'll come to it. They were the first to bring, but they did not market it on the mass scale. Because of their business model, they played the role because it was more costlier than printer. Okay. And continuously to sell that role, they made the profit. So they did not adopt the new technology. Which technology? Bullet and gun technology. Okay. So but that is why they did not survive, because that strategy failed, no, ultimately. Same thing with Nokia also. We'll discuss it in the next paragraph, so I'm just reserving my discussion on this Nokia. So this is strategic risk. Strategic risk means simply a strategy going wrong because of some unforeseen changes in the business world. Anything can happen. Even companies like Nokia can fail. You can understand 89% or 90% of the world mobile phone market. Now, what is the status of Apple right now? Was the status of Nokia at a point of time? Everybody I have seen in the classroom some years ago had Nokia phone only, different versions. But now I don't find anybody using Nokia phone. Maybe 1 out of 1,000 students who come to the class. This is strategic risk. And you really can't do much about it. The only thing is you have to continuously innovate and be in line with the latest technologies, latest trend, what customers want. So strategic risk is a risk in which a company's strategy becomes less effective and it struggles to achieve the goal. Underline. This is strategic risk. Last point I have highlighted in your notes also. You can underline. What are the reasons for strategic risk? Why strategic risk is there? First is changes in technology, as you know. Okay. Like this example of Nokia. What went wrong with Nokia, you know? It was based on a push button system. Mobile phone had buttons. A, B, C, D is written there. And then you push it, then it gets typed. Okay, but now this Samsung and Apple, they came out with a touch screen mobile, which people liked very much. They were little late in that. By that time, Samsung and iPhone or Apple had captured the market. That is change in technology. Okay. Or your company may be manufacturing, say, a kickstart scooter, which I give the example, kickstart scooter like Chetak. But then Honda company came out with Activa. Okay. So that is a push button scooter. What will you prefer? Push button scooter. No hassle involved. Just you press the button, the bike starts. Okay. Then there were scooters and car based on gear technology. You have to keep changing the gears. Nowadays students may not even know that in scooters there were 4 gears also. Do you know? Have you driven? No. I have driven. Okay. This Bajaj scooters had these 4 gears. 1 in front, 2, 3 behind. Vespa scooters. But nowadays I don't find scooters which has got this gears. There is only 1 gear. Same thing is happening in cars also. Changing the gear of a car is a very tough task. But nowadays there are gearless automatic cars. They automatically take the position whatever is required. So that is technological change and it will make some models outdated. Okay. These are some examples I am quoting you, which you understand better. A new competitor entering the market. Jio. That is the best example. Jio has made life of other telecom company miserable. They were making huge profits some time back and now these competitors are into losses. How will you compete with a client or a company like Jio who is offering free service for everything that you consume on your mobile phone? How do you compete with that? Voice free, data free. There is no way you can compete with such people. Okay. A new competitor entering the market. Then shift in the customer demand. Customer wants now, suppose, push button scooter only. He does not want kickstart. You have to change. Okay. Slowly and slowly customer would want automatic gear, not that manual gear system. Car company will have to change, and those who can't change in time will go out of the market. Then the customer may want a touchscreen mobile phone. Those who don't want to change to touchscreen mobile phone, those companies will go out of the market. Then increase in the cost of raw material. This is a strategic risk. Your company is suppose dependent on coal for power generation. Price of coal can go up. Your company may depend on oil for some activity, or silver for some activity, or for gold for some activity. Price of oil, silver, gold may go up. Any raw material can go up. And you don't know how much it can go up. It all depends on demand and supply. And any number of other large scale changes. Like for example, change in government policy. Suppose government brings demonetization. Don't you think a lot of strategies will undergo a change now? Many businesses are dependent on only cash transactions. And government says no longer 500,000, 2,000 rupees notes are available or useful. Your business strategy can undergo a change and you can be gone out of the market also. Then new substitute product may available. Substitute product. Substitute products are also going to change the business, increase the business risk. Now some examples we have written here. Kotak. Why we have written Kotak here? Kodak. Kotak still has some time to go. Kodak was able to develop a digital camera. You said it was right, digital camera they have developed. But they found that selling the roll was more profitable. But it considered this innovation as a threat to its core business model and failed to develop it. Many people do not understand that you have to leave your past and think for the future, and this company was sticking to its past and therefore it could not survive, failed to develop. It paid the price because when digital camera was ultimately discovered by other companies, it failed to develop it and left behind. And nowadays you don't get much time to react. You have to react it immediately. 1 year is also a very long time. Your market share will be completely taken away by the competitor. Nokia, as we know, was a world leader. 90% of the world market it has captured. It had come out with so many different varieties of handsets. But then what happened? Apple launched the touchscreen mobile phone, which was copied by Samsung and other companies in China, Korea, Japan. But Nokia was still selling that same old keypad. You have to type A, B, C, D here or there. It was very difficult. If you want to type A, E gets typed, meaning gets changed. Okay. And then other company became mobile leader. But there is a company called Xerox, one of the well-known companies in the world. Xerox, students' favorite company. Most of the notes that you have in your hand is Xeroxed, photocopied. This company became so popular that we don't use the word photocopy, we use the word Xerox. But it is the name of a simple company in USA. Now, a positive example can be given in the case of Xerox, which invented photocopy machine. In fact, you don't know the story of Xerox. One young man had developed this photocopying technology. Okay, he went to different companies, said, see, I have this technology and I want to sell this technology to you and do business. many companies in that time, 100 years ago, they refused to take that technology from him. He said, why do we need to copy something? Why do we need to take a photocopy of this page? So this will not work. But then Xerox company understood that idea, and it acquired the technology from a young man. And then they realized that this is a very powerful thing that we have developed. Copying will become the future. Okay. So that is the story of Xerox. It was not originally developed by this. Somebody in some college going student had developed this technology. They purchased it just for a few dollars, and then they made billions of dollars out of it. But then what happened now? Laser printing has come. Earlier, the photocopying was a very cumbersome process. Each page you have to keep in that machine, and then it takes some time to process. One page will come out. Again, you remove it, you put the other one. But now there are hundreds of pages you can print in some seconds only. Hundreds of pages. 1,000 pages you can print in an hour now. More than that. In the same sequence in which it wants to appear. Sorting, etc. is done. But this company was smart. It understood the future. It brought the laser technology, and then with the help of this, the printing technology has become very, very fast. It adopted. Since it adopted, it survived, and its profit escalated further. That was some note on strategic risk. The same discussion is there in your SFM syllabus also. Next is compliance risk. This is something which I hate. Okay. In India and in every country, not only in India, there are so many regulations you have to comply if you do a business. Do you know that? Some regulations that you need to comply in India. If you are a company form of organization, Companies Act. If you are a listed company, then hundreds of SEBI regulations are there. If you are a banking company, RBI regulation, Banking Regulation Act, periodically the central government will keep on issuing notifications. So those things you have to follow. Then income tax is there. Very complicated. Every month you have to deduct TDS of several people, deposit. GST is there. Monthly. And there are many other laws. PF laws are there. If you have 10 and more employees, you have to pay PF. Gratuity law. Bonus Act is there. Local regulations may be there. You have to open your shop after 9, close before 7:30 or 9. These are also regulations. You can't employ women after 7 o'clock in the evening. Factories Act are there. So this is compliance risk. And the problem is that if you are not able to comply, they will charge you fines, penalties, which will again affect your bottom line. You have to put some extra people only to comply with the regulations. Okay. Non-compliance lead to penalties in the form of fine. In some cases, imprisonment also. But that is extreme nowadays in India. You can pay the fine and penalty and you can escape. However, when a company ventures into a new business line or a new geographical area, the real problem then occurs. That means if you start a new business, you again have to think about a new set of rules and regulations. Since you are already accustomed to one particular type of business, you may not be aware about the other rules and regulations. That's called compliance risk. A company pursuing cement business likely to venture into sugar business in a different state. But rules applicable to cement business are not necessarily same as sugar business, and that too in a different state, because each state have a different rule for sugar business. In case if you don't comply, there is a compliance risk. You have to pay fine, penalty, imprisonment, and that will affect your profit, reputation. Next is operational risk. That is what you call in audit. internal risk, people risk, process risk. People risk, process risk. Very serious risk in a business. You have heard this Punjab National Bank scam some years ago, 1 or 2 years ago, for example. Now, what is that? That is a people risk or process risk. Somebody is issuing letter of undertaking, means guarantee, thousands of crores of rupees of guarantee that fellow has given on behalf of PNB, and nobody is there to check also whether he should do this or not, whether he is authorized to do this or not, etc., etc. And the other parties, so many people. One was Mr. Modi also, I think, Nirav Modi, Mehul Choksi. They have withdrawn a lot of money. They have gone out of India also. They have taken a passport also of a different country, and the government will struggle to catch them now. That is a people and process risk. Mehul Choksi says he can't take a flight of 48 hours. So then you can come in installment. Na? First you come from that place to point A, B, C, take 12-hour flight 4 times. Because the moment he comes, he'll be caught and then he will go to jail. So that is the risk. Indian jails are not safe for rich people. It does not mean I have gone, but I am not rich first of all, and then I have not gone also. That is why in companies a lot of internal control procedures are adopted, and Companies Act have made internal audit also mandatory, so that whatever maximum possible you should be able to check the fraud error that might be committed. Instead of punching 1 lakh rupees, somebody may punch 10 lakh rupees. Just it's a manual error. Somewhere we have to put some number in our system manually. Later on the computers may take its own course, but there might be some manual intervention involved in every company, and that involves your people risk. People in the organization understand there is a loophole in the system, he can take benefit out of it also. If he knows that the stock is never counted by this company, while leaving the office in the evening, he can put two items in his pocket and go away also. Is it right? So that is called people risk and process risk. It also relates to failure on the part of the company to cope with the day-to-day operational problems. As the organization becomes bigger and bigger, the problems, this operational problem will also become bigger and bigger also. So it relates to people and process risk. Now see one example of operational risk. An employee paying out rupees 1 lakh from the account of a company instead of rupees 10,000. It may be intentional or unintentional. He has to debit 10,000, he has debited 1 lakh. So what the companies need to do? Companies need to have some internal control system in place. That is what they can do. They should be able to identify the loss immediately. The moment 1 lakh has gone, it means there must be some system to tell you, no, it should have been a different figure. So companies will have to keep the internal control system stronger, either using information technology or using manual intervention also. That means what they do in practical world nowadays, every employee is given some limit to make the payment. The moment he wants to make more than that, system does not accept only. Or there will be a system where whatever amount he has done, before it is finally paid, it is checked by other party. So in our office, my staff has to upload all the payments on the system. But the payment is not processed unless I will first approve and check it whether it is properly written or not. So that means there is a double layer of check. Even if suppose my staff has to pay to a vendor 2 lakh rupees and he has put 20 lakh rupees in the system, that system will not work because first I have to approve it. and then the payment gets done. So such kind of system can be installed in the company. Every system has a cost also, so one has to look into the cost and benefit analysis. Is it right? So use of authorization, use of limits, work done by one party, checked by another party, all these are introduced in the companies so that the risk is minimized. Next is called reputational risk. What is reputational risk? Company's reputation can be affected because of a decision, both in positive and negative way. Positive and negative way. Now, one negative example first we'll see. There is a company called GM, General Motors. They have closed a project in India. They have closed a project in India on the grounds of viability. Now, how does it affect the reputation of the company? Good or bad? Bad reputation. Why? Because will the new employee like to join such companies in future? If they have an option, they will not. Because who knows, after they join the company and the company says no, now we are closing our operations. Again, you have to search for new jobs, which is not very easy in a competitive environment. So they will feel insecure. Or for example, this gentleman is saying PwC, Satyam case, reputation was hurt. Employees left, new employees did not join for some time. So it takes a lot of time to re-establish that reputation again. Okay. Or say simple example, a company selling mobile phone. One of the tablets catches fire. Many customers will simply stop buying that product only. Or say for example, a car company. Suppose a car catches fire. I'll tell you that company has gone out of business now. There are companies. People will not take a chance with that kind of risk. Okay. That is reputation risk. Or for example, an airline staff, he hits a passenger. It affects the reputation of that airline company. So companies have to be nowadays very careful because of this Facebook and Twitter and Instagram. Any wrongdoing of the company immediately spreads. Okay. On the other hand, added related products down the line adds customer confidence and boost investors confidence also. But you can improve your reputation also by doing good things. For example, Indian banks have embarked on opening a e-trading account. Gone are the days when we have to go to the broker or call the broker and buy the securities. You can simply open an account, demat account, and they will give you user ID, password on your mobile. You can easily do trading of shares, etc. And this has added to the reputation and market confidence also. Okay. Now next risk, we have covered business risk now. In business risk, what we have covered? Can you just summarize 4 items? Strategy risk, compliance risk, operational risk and reputational risk. The question in the exam can be like this. Which of the following is not a business risk? And then give you 4 options. 3 of them will be one of these items and 1 will be something else. They will say interest rate risk. Interest rate risk is not a business risk. Exchange fluctuation risk is not a business risk. That will put under, say, financial risk. So that is one question, keep in mind. Financial risk is referred to as unexpected changes in the financial conditions. So example of financial risk is price rate. Price means your interest rate will change, not price of your raw material. That is a business risk. Here the price means you can say price of funding the business, interest rate, because that is a price of borrowing. Exchange rate may change. Credit rating of the company may change. Interest rate they have written separately also, no problem. Prices of, you can say, debt instrument can change. With the change in market interest rate, the value of debt instruments can change. Though political risk is not a financial risk in a direct sense. So political risk we should study under other heading. It may not be called a financial risk in direct sense, but same can be included as any unexpected political change in any foreign country may lead to country risk, which ultimately result in a financial loss. So political risk is another risk we will discuss in a separate heading below. Political risk means change in the politics in a country may cause loss to a given company. USA, many countries including India also. Coca-Cola was banned in India some years ago, some decades ago, and they had to really shut down their company in India, all operations, wind up and go back to USA. In many states now, soft drinks are banned, pizzas are banned, burgers are banned. So these companies have invested crores of rupees, they will have a financial loss. Maggi is banned for some years, okay, almost 6 to 8 months, and I had really bad time during those days. Still we used to manage somehow in black market, okay. Anyway, we'll come to financial risk. Again, 4 categories of financial risk we will cover quickly: counterparty risk, political risk, interest rate risk, and currency risk. Counterparty risk, I will briefly explain. It is the risk of default by the counterparty. Means counterparty will not honor his obligation. That is counterparty risk. You have given goods, sold goods on credit. What is the counterparty risk? He may not pay. You have entered into a derivative contract, forward contract. I will buy 1000 kgs of wheat at 20 rupees per kg. Other party does not deliver wheat only at 20 rupees per kg. That is counterparty risk. You have an inflow of foreign exchange. You go to a bank and you say that I am going to deliver $1,000 at 70 rupees. And then you do not deliver or the bank does not accept. That is a counterparty risk. Okay. So this is a serious financial risk, especially suppose the other party does not make you the payment. When you are going to receive the payment, he does not pay you interest, he does not repay the principal, he does not pay you the amount due. Next we will see political risk, already discussed. Political risk is when you are dealing with different governments. Different government means countries which have different types of governments. You're dealing with different countries. Government policies can change with the change in government, with the change in the political system. Your company operating in that country might suffer a loss. Example you see, very serious example of political risk. The heading should be forms of political risk here on the screen. The example is confiscation or destruction of overseas property. Yes or no? Suppose tomorrow some political party in India decides, no, we will not have McDonald's in India. All McDonald's shops will be broken. People who don't have any other work, they will come out with all rods, hockey sticks. They don't play hockey with the hockey stick. Hockey stick has a different meaning and use in India. It is used for breaking things and breaking heads. So they start destroying the property of MNC companies. Government can sometimes confiscate their assets. Possible. You can't do anything in foreign country. Then rationing of remittance to home country. Many governments in foreign countries, they say whatever you earn, you can only remit say 40% of this. 60% or 50% you keep in our country only. You can't remit the entire amount. Restriction on conversion of local currency of host country into foreign country currency. So there can be restriction on conversion also, restriction on borrowing, invalidation of patent. Your patent may not be applicable there. Like it happens in USA. They can copy your product. You can't do anything. In China, they can copy whatever you have developed, officially or unofficially. Then price control of the products also. There are quality checks also. Do you know that? Some countries are not allowed to sell goods in other countries only. These are political risks. They may ban MNCs altogether. They may ban FDI altogether. And company has to shut down. Next is interest rate risk. This you will study in detail in SFM. There is a separate chapter also, interest rate parity theorem, interest rate derivative products. What is interest rate risk? Rate of interest can change. Oh, so what is risk in that? If you are a borrower in floating rate, interest rate goes up. Identify the risk. You have to pay more interest. If you are borrowing in fixed rate, but interest rate falls, again there is a risk. You have to continuously pay at a high rate of interest. If you are an investor, same risk. You have invested in a fixed rate instrument, interest rates have gone up. You will still receive fixed rate of interest, and vice versa. You may have invested in a floating rate instrument, interest rates may fall, and therefore you will get lower interest rate. Change in interest rate affect the value of assets and liabilities. There is an inverse relationship between the value of asset and liability and the interest rate. Higher the interest rate, lower the value of the bonds and debenture. That is interest rate risk. You don't have to do anything. Change in government policy and RBI's policy may make you poor automatically. You don't have to do anything to become poor. Government will make you poor overnight. Some entities, let's say for example, State Bank of India, they are holding bonds of thousands of crores of rupees. A 50 basis point rise in the interest rate will reduce the value of these bonds, and they will have to book that loss. Is it right? So banks, insurance companies, large corporates, they are exposed to this risk. It affects your inflows and outflows of cash. It affects the value of your assets and liabilities. And you really can't change it because it is all affected by now global trends also. Even a US interest rate changes, Fed Reserve decides to change interest rate, it might affect the value in India also. Okay. So this interest rate risk, interest rates are of two types, fixed and floating. If the company has borrowed money at floating rate, then the increase in floating rate, the liability, with increase in floating rate, the liability under fixed rate shall remain the same. This fixed rate with falling floating rate, the liability of the company to pay interest rate under fixed rate shall comparatively be higher. You can always express in your own words, you have borrowed at fixed rate. Interest rate goes up, enjoy. You will pay at a fixed rate. But reverse happens. The interest rate falls down and you're a borrower, still you have to pay at the fixed rate of interest. Then you will say we should borrow at floating rate. In floating rate, as the interest rate goes up, you have to pay more interest. Interest rate is easy because you have learned in detail in SFM. And similarly, this currency risk is also easier for you. The entire foreign exchange management chapter in SFM is all about currency risk. So if your company deals in foreign exchange as an exporter or importer, borrower or lender, change in exchange rate will one, affect your cash flow, maybe positively, maybe negatively. I am not explaining too much in detail, you know it. If you are an exporter and exchange rate goes down, what will happen? Less inflow. If you're an importer, exchange rate goes up, what will happen? More outflow. If you're a borrower, exchange rate goes up, more interest outflow and more repayment of principal, which is the problem with many Indian companies right now. When they borrowed money 10 years ago, exchange rate was 50, 45, now it is 70. So 25-30 rupees extra they are paying because of the exchange fluctuation. That is currency risk. It may affect you positively and negatively also. Exporters benefit when the exchange rate goes up. Like for example, Infosys is happy, dancing with joy when exchange rate moves from 60 to 70, because now for every dollar they get 10 rupees more. But importers like Indian Oil Corporation, who imports the crude oil, they suffer. These are the risks. Who does all this evaluation? The credit rating company. Is it right? The credit rating company will do all these evaluation before they will give you a credit rating. Is it right? Now we will take a small break.